Can I tell you the biggest scam in investing? Wall Street wants you to believe that if you just mimic them, run where they run, copy their every move, you'll get rich. That's not just wrong. That's dangerous. The fact is, most investors fail by following the herd, and I'm going to tell you exactly why, and more importantly, how you can do better by thinking differently. Picture yourself in a casino with bright lights, men in expensive suits, champagne flowing, the house always wins. That's Wall Street's game. When you watch the financial news or see an analyst boosting this stock and bashing that one, remember they make money off movement, off panic, not performance. Wall Street advisors want you to feel like you're outmatched. Don't try this at home, they say. You need more math, more computers, more of them. That's how they keep the fees rolling and the mystique alive. But here's what they don't want you to know. The S&P 500 is basically a list of yesterday's winners. Piling into today's hottest trend is like trying to join a party an hour after the last pizza box is empty. Plus, mutual fund managers are handcuffed to their benchmarks and bosses. They're not hunting for 10-baggers. They're just trying not to get fired. Do you want to invest like someone scared to lose their job, or do you want to invest like someone who wants to win? Let me paint you a picture of what happens when you try to copy Wall Street. You hear a big fund manager just bought 1 million shares of some tech company. You scramble to buy some shares because, hey, they must know something, right? Wrong. By the time you read it, it's ancient news. These guys had their reasons. Maybe a model, a trading floor rumor, or just a bet over golf. When you copy Wall Street, you're always behind. Information travels fast, and by the time you act, the value is gone. You don't know the secret reasons behind their moves. Maybe that tech stock was a hedge, a pair trade, or an obligation. And you never see their mistakes. Heard about their losers? Of course not. Those don't get press releases. It's like copying someone else's answers without understanding the test. Here's the shocker that Wall Street doesn't want you to hear. You, the so-called amateur, have built-in superpowers. Why? Because you're nimble. You spot the stories in your town, not just in spreadsheets. Let me tell you about Legs Pantyhose, a true story from the grocery store. I noticed piles of those egg-shaped containers vanishing from supermarket shelves every week while competitors gathered dust. Wall Street missed it, but my family couldn't stop talking about them. So I bought the stock. That's the method I've always believed in. Invest in what you see winning around you. Your local pizza spot, your favorite cookie in the supermarket, the lines at your kid's school for a new sneaker. These are secrets the pros sitting in high-rises can't see. But most investors throw away this edge. Why? Because they trust that the guy with the biggest yacht knows best. That's like picking a car because it's shinier, not because you checked under the hood. You want to be what I call a story investor. That means understanding not just what a company does, but how it'll win, grow, and last through storms. Can you explain it in 2 minutes to a 10-year-old? If not, move on. There are 6 basic categories of companies worth understanding. Slow growers are utility companies. Boring? Maybe. But the pipes keep running and the checks keep coming. Stalwarts are your McDonald's, your Coca-Cola, the giants that chug along decade after decade. Fast growers are the teen phenoms, today's hot tech, a regional donut chain adding 50 new stores a year. Cyclicals are autos, steel, companies that move when the economy turns. Turnarounds are on the ropes but not dead yet. Think Chrysler in the 80s. Asset plays are companies with hidden treasures, maybe real estate, patents, or other assets Wall Street's ignoring. The number one rule is this: only invest if you understand the company's story. Can you explain why earnings will increase? If so, you're a step ahead of most fund managers, believe it or not. Here's a true story. In the 80s, Dunkin' Donuts started opening new locations everywhere. I noticed customers kept packing the parking lot, and the coffee was the talk of the town. Meanwhile, Wall Street was obsessed with high-tech everything, even companies with zero earnings. We bought Dunkin' because we saw the story on Main Street. Growing stores, lines out the door, new markets. The result? It doubled, then doubled again. The fad companies? Most crashed and burned because if you can't see the story with your own eyes, don't expect someone on Wall Street to see it from the 50th floor. Ever heard someone say they're waiting for the perfect time to buy when stocks are cheap? Or they want to sell before the crash? Silly statements. Here's the fact. Market timing is impossible. The pros can't do it. I can't do it. No one can. Even computers get it wrong. The Dow didn't go from 800 in 1980 to over 30,000 because someone rang a bell telling us when to buy. It happened one earnings beat, one dividend, one expansion at a time. That's the secret. Focus on the company's core story, not the daily ticker noise. So next time you feel like selling because the market looks scary, remember it looked scary before every major bull run in history. Let's rip apart a few myths. Myth number 1, you need an MBA to beat the market. Garbage. Common sense beats a fancy diploma any day. Myth number 2, buy low, sell high is all there is to it. Not if you don't know why you're buying or selling. Myth number 3, Wall Street always wins. False. 3/4 of mutual funds can't even beat the index over a decade. So next time you're tempted to follow the herd, ask yourself, will the herd make you rich or just trample your wallet? Most 10-baggers aren't lying on Wall Street's radar. They're lurking in everyday life. Here's what to look for. Companies with a simple, understandable story. You know what they sell and why people buy it. Earnings that are likely to increase, not just this year, but for years. Low debt. Companies that aren't one bad month away from trouble. Room to grow. Are they just in Minnesota but planning to open in Texas? Managers with skin in the game, the folks running the show, own real shares. Ask yourself, does your plumber own stock in cleaning supplies? Probably not. But maybe he notices one rust remover outselling the rest in every supply shop in town. That's where research beats rumors. Forget market predictions, price targets, exotic charts. Here's what matters: earnings. If a company makes more money each year, the stock will usually follow. When you focus on earnings, you can ignore the stock market circus. You're not buying lottery tickets, you're investing in businesses. If the company's earnings double, odds are good your investment doubles too. But be skeptical. If a company's story is we'll be profitable one day, move on. Find companies making money now or with a clear path there. Just look at Walmart in the 70s. Humble, boring retail stores, but earnings grew every single year. You could have made a fortune if you noticed early. You don't need to be a CPA to spot good numbers. Ask these questions. Are earnings per share rising or falling? Is debt low or can they pay it off? Did cash flow turn positive or negative this year? Are there more stores, more trucks, more sales outlets than last year? If you can check those boxes, you're thinking like a pro. But skip complicated ratios and Greek symbols. They confuse more than they help. Remember, companies don't go under because the P/E is too high. They go under when they run out of cash and can't pay the bills. Next time you walk into a store, look around like an investor. Are customers running to a shelf? Is there zero inventory? Are people raving about the new sandwich at lunch? If you see a story unfolding in the real world, dig into the balance sheet. Did the stock respond yet, or is Wall Street asleep at the wheel? This is how you find winners. Not by staring at charts, but by noticing what's selling like hotcakes. Most people invest by following the latest market trend. Boring. Great value can hide in plain sight. Asset play means a company owns something valuable. Wall Street isn't noticing. Land, patents, inventory. In one case, a sleepy New England insurance company secretly owned acres of timberland worth more than the entire company. The stock price didn't reflect it, but the land sat on the books for peanuts. If you dug deep, you struck gold. Find the cookie jar the market missed, and you've got a ticket to the upside. Once upon a time, premium dog food was sold at a single local store near Boston. The owner couldn't keep the shelves stocked. Word of mouth, packed lines, repeat customers. But Wall Street analysts yawned. Smart investors noticed a surge in repeat visits, growing demand, a simple story. People will pay extra for pampered pups. When the company expanded nationwide, early believers saw their money multiply. Why? Not because of some analyst spreadsheet, but because the story was clear. Growth, loyal customers, and expanding earnings. A turnaround is a beaten-down company everyone hates, usually for good reason, but not always. Picture Chrysler in the early 80s. Headlines scream bankruptcy, cars piled up unsold. But dig deeper and you'd see new models, new leadership, the loans to survive. People willing to hold their noses and buy during the darkness saw their bet multiply several times over. The rule here is don't catch a falling knife unless you see the turnaround story. Leadership change, cost cuts, a credible plan. Otherwise, you're just donating to the losers club. You ever get a hot tip from a cab driver or dentist? Buy this stock, guaranteed winner. Most people who act on that get burned. I call it cookie madness. Once everyone's chasing the same cookie, it's too late. Remember, the only people who consistently make money from tip sheets are the folks selling tip sheets. Amateurs have survived and thrived for decades by ignoring tips and trusting their research. Be patient. Wait to understand the story, not the hype. You know why most people never get rich in stocks? Not because they pick losers, but because they don't hold on to winners. Someone doubles their money and sells. But if it keeps doubling, they miss the next 4 doubles. I made the bulk of profits from a handful of 10-baggers in a sea of forgettable stocks. Your goal is to hold the handful while culling the worst. That's how fortunes are built, not by trading, but by holding. So next time you're tempted to sell a winner, ask, has the story changed? If not, keep your seat. You ever notice how the news runs doom and gloom after stocks fall, then turns upbeat when they rise? Media sells subscriptions, not investment advice. Here's the reality. Some of the best bargains hide during the worst headlines. Take the early 90s. Banks crushed in the papers, but underneath, the healthiest ones were fine. Patient investors who looked beyond the headlines made a killing. So when you see a scary headline, ask, is the company still growing, making money, and paying down debt? If so, maybe it's a buy. Cyclicals are stocks like autos, airlines, steelmakers. When the economy is hot, they boom. When it's cold, they bust. Here's the trap. If you buy at the peak when earnings are highest, you set yourself up for trouble. The time to buy is when the numbers are ugly and nobody cares. Sounds crazy, but that's where the gains are. Think airlines in the mid-2000s. Everyone thought they were doomed, but some bounced back strong. Read the cycle, not the headline. You ever see a group of people crowding into a store and decide to join in? No idea why? That's groupthink. Most mutual fund managers stick close to benchmarks because it's safer for their jobs. If they all miss, nobody gets fired. But if you miss alone, it's career suicide. That's why true winners stand out. They hunt alone, trust their homework, not the crowd. If everyone's recommending the same stock, odds are the upside's already priced in. Find the lonely stories, the ones with clear growth and no fans. Debt can supercharge a business, but it can also sink it. When you look at a company, check how much it owes. Companies with clean balance sheets can weather storms. The over-leveraged sink when times turn. During the recession of 2008, the big winners were not necessarily the flashiest. It was those carrying the least baggage. A simple rule. If you don't understand how they'll pay the bills, walk away. Let's go back to a battered old shoe company. Stock plummeted, stores closed, analysts said game over. But a new CEO took over, slashed debt, redesigned the shoes, and opened fresh markets. Investors who'd done their homework and saw the turnaround, not just the headlines, made huge gains. Point is, don't just focus on the numbers. See the story changing, up or down. This is gospel. Don't buy a stock unless you can give a 2-minute pitch. What do they do? How do they grow? Why will earnings increase? If you can't answer, step aside. Investors who buy just because it went up get burned. Think Main Street over Wall Street. Ask your neighbors what's hot, what products they're using, what stores they're avoiding. Sometimes your barber knows more than a Harvard MBA about which fast food chain is crushing it. If the CEO is buying company stock with their own paycheck, not options but their own cash, that's a great sign. If they're selling nonstop, maybe there's smoke. If you see insiders gobbling shares, maybe they know something Wall Street missed. But don't just follow, do the homework. Check if earnings are growing, debts are shrinking, and the company story makes sense. Every story, every analysis, every meeting leads back to this. Will this company make more money year after year? If yes, ignore the noise, forget predictions, and hold on. If not, ditch it. People who remember this core lesson are the ones who turn small fortunes into big ones. And those chasing the flash in the pan, they're the market's lunch. Let's get honest. Even pros mess up. Nobody bats 1,000. I bought electronics makers that looked amazing on paper until their competitors cut prices to the bone, lost money. I bought airline stocks just because oil prices dropped, then came a recession. What do you learn? First, never ignore industry changes. Second, never bet the farm on any one stock. Diversify. Own enough so that one loser won't sink your boat. But also, trust your instincts. No one else cares about your portfolio like you do. Imagine buying a small regional retailer, adding stores every month, all reporting lines out the door. The numbers go up, the competitors stumble, and expansion continues. Doesn't take a genius to see that. That was Walmart in the 1970s for anyone paying attention. 10-bagger? Try a 100-bagger. Be the person who walks through the store, talks to cashiers, counts cars in the parking lot. If the story makes sense, the numbers check out, and the world hasn't caught on yet, you might just hit a home run. Wall Street's playing chess on a crowded board. You can find the overlooked checker on the other side of town. Lots of folks swear by index funds. They're fine if you just want market returns. But if you want to beat Wall Street, not just join it, you need to discover stories the index doesn't capture. Index funds can't own a local bakery expanding regionally. They will never buy a company unless it's big enough to make headlines. Amateurs can. That's your edge. Even the best stories can rot. Maybe a fast-growing store chain starts missing sales targets. Perhaps debt piles up or management changes the plan. Don't marry your stocks. Date them. Stay alert. If the story changes, don't stick around out of loyalty. Cut your losses and move on. Only hold if the story holds. And remember, Wall Street rarely gives you warning before the crowd rushes for the exit. It's tempting to own a zoo, 20 different stocks in every sector just in case. Problem is, you can't follow every story. If you want to win, own a handful of stories you know. Follow their earnings, check up on their expansion, visit their stores if you can. A good number, between 8 and 12 stocks. More than that, you're juggling chainsaws. Remember, the more you know, the better you sleep. Not because you see the news, but because you understand your companies. Stocks will fall, guaranteed, sometimes by a lot. But amateurs have an edge. You don't have to sell. Pros often do. Jobs on the line, redemptions, panic in the streets. But if you know the story, you can hold tight. Stocks are only dangerous if you need the money tomorrow. But if you're in for the long haul, price drops are sales. Remember the grocery metaphor. When soup's half off, do you buy less or more? Hold through storms if you trust the story. If you don't, sell. Let's tackle the million-dollar question. When do you buy and when do you hit the brakes? The way I've always approached it is simple, not easy. Buy when the story checks out, earnings are rising, debt is manageable, and the world hasn't priced in the potential. Hang on as long as the company keeps delivering. But when debt balloons, earnings stall, or the story gets muddy, start packing your bags. Don't sell just because the price goes up. Sell because the reasons you bought have changed. If a shoe chain stops opening stores or a fast grower slows down, maybe it's time to move on. Let's get right to the actionable tools, a checklist you can use every single time you look at a new stock. Understand the company. If you can't explain how it makes money, move on. Categorize it. Is it a slow grower, stalwart, fast grower, cyclical, turnaround, or asset play? Scuttlebutt. Ask around. Are real people using or loving the product? Check the numbers. Are earnings and sales growing? Is debt under control? Look for the undervalued. P/E less than its growth rate is a good sign. Hunt for hidden assets, land, patents, brands not recognized by Wall Street. Management. Are insiders buying? That's confidence. Are they selling? Could be a warning. Think long term. Would you want to own this if the market closed for a year? Ignore the macro noise. Don't obsess over recessions, inflation scares, or election cycles. Focus on your company's story. Remember, not every box needs checking, but the more you tick, the safer and smarter your bet. Let me run through some rapid-fire stories and lessons. Ford. I bought Ford after it was left for dead. I saw a turnaround brewing while the market panicked. It rebounded spectacularly, proving the value of patience and fundamentals. Taco Bell. It started as a regional fast grower. I saw huge demand, high restaurant traffic, and room to expand long before analysts paid attention. That's the power of scuttlebutt, boots on the ground. Fannie Mae, a sleepy asset-rich stalwart. I held for years through ups and downs, relying on steady earnings and cash flow, not hot tips or media noise. Philip Morris, controversial? Sure. But profits and cash flow were real. I always let numbers, not headlines, call the shots. Every success was based on rules. Own what you know, do your homework, and focus on fundamentals, not price charts or Wall Street's opinion. Let's kill the last Wall Street myth right here. You already have what it takes. Some of my best ideas came from my wife spotting the best-selling pantyhose or my kids demanding a certain cereal. You know what's selling at your local mall. You know which restaurant is packed, which gadget everyone's talking about, and what nobody's buying. Use that knowledge. The market is just a collection of stories, yours to discover every day. Here's the honest truth. The biggest danger isn't Wall Street. It's in the mirror. Panic when stocks fall. Greed when they rise. Chasing gains. Bailing on losers too late. If you invest with discipline, story, and real homework, your emotions become your greatest advantage, not your downfall. I ran the Magellan Fund through wild markets, disasters, crashes, you name it. But I always return to two questions. What's the company's story, and will its earnings be higher in 5 years? If the answer is yes, you sleep just fine. If not, sell or don't buy in the first place. From 1,977 to 1,990, I managed the Fidelity Magellan Fund and delivered a 29% average annual return, transforming $18 million into over $14 billion. That's the best performing mutual fund of all time for that period. If you invested $10,000 with me in 1977 and held until 1990, you'd have walked away with over $280,000. But here's the kicker. Most Magellan investors actually lost money. How? They chased performance. They bought after big years, like 1,980's 70% return, then panicked and sold during rough patches. Classic amateur mistakes. Buying high, selling low, never sticking to the plan. The fund didn't fail them, they failed themselves by ignoring the golden rule. Hold on through the storms if the story's intact. You want to know the difference between winners and losers? Patience. The Magellan Fund held over 1,200 stocks at one point, but the bulk of gains came from just a handful of 10-baggers, the ones I held while others panicked, the ones where the story kept improving year after year. Most people can't do that. They sell winners too early and hold losers too long. They let fear dictate decisions during downturns and greed take over during rallies. If you learn one thing from the Magellan story, it's this. Returns don't come from timing the market or chasing the hottest funds. They come from buying great stories and holding through thick and thin. Let's break down those 6 categories again, but this time with real strategies for each. Slow growers are the big mature companies growing at snail speed. Think utilities or established industrial giants. Not exciting, but they pay dividends and won't vanish overnight. Your strategy? Buy them for income and stability, not massive gains. Don't expect miracles, but don't fear disasters either. Stalwarts are the Coca-Colas, Procter & Gamble's, and Johnson & Johnson's of the world. Reliable, steady, predictable. Your play? Buy them when they're temporarily out of favor, maybe a bad quarter or negative press. Sell when they're up 30 to 50%, then wait for the next dip. Rinse and repeat. Fast growers are small, aggressive companies growing earnings at 20 to 50% annually. This is 10-bagger territory, but also where you can lose your shirt. The key? Make sure growth is sustainable. Check if they're expanding into new markets, opening stores, or launching new products. And watch the P/E ratio. If it's sky high, you might be late to the party. Cyclicals are autos, airlines, steel, chemicals, industries that boom and bust with the economy. The trap? Buying at the peak when earnings look great. The opportunity? Buying during the trough when everyone thinks they're doomed. Timing is everything here. Enter when things look awful, exit when they look rosy. Turnarounds are beaten down companies clawing back from disaster. High risk, high reward. Before you dive in, ask what changed. New management, debt restructured, a new product saving the day. If you can't point to a concrete turnaround story, it's just a sinking ship. Asset plays are companies sitting on hidden value, real estate, patents, inventory, cash. Wall Street often misses these because they're boring or obscure. Your edge? Dig into the balance sheet and find assets trading below their true worth. It's like buying a dollar for 50 cents. Here's a tool Wall Street loves to overcomplicate, but it's dead simple. The PEG ratio. That's price to earnings divided by growth rate. If a company has a P/E of 20 and is growing earnings at 20% per year, the PEG is 1.0 fair value. Below 1.0, potentially undervalued. Above 2.0, you're probably overpaying, but don't be a slave to formulas. Use the PEG as a starting point, then dig into the story. A company growing at 30% with a PEG of 1.5 might still be a steal if the growth is sustainable and competition is weak. You don't need to be a CPA to spot winners. Focus on these 5 things. Revenue growth. Is it going up consistently? If not, why invest? Earnings per share. The bottom line. Are they making more money per share each year? Debt to equity ratio. How much do they owe versus what they own? High debt can be dangerous, especially in downturns. Free cash flow. The actual cash left after expenses? Positive and growing? Good sign. Return on equity. How efficiently are they using shareholder money? Above 15%? You're in good company. That's it. 5 numbers. If they're trending the right way and the story makes sense, you've got a potential winner. This is the fun part. Scuttlebutt means getting out into the world and asking questions. Talk to customers, employees, competitors, suppliers, visit stores, count cars in parking lots, read online reviews, check social media buzz, say you're eyeing a retail chain, go visit a few locations. Are they clean, busy? Are employees helpful or miserable? Are shelves stocked or empty? Are customers buying or just browsing? Wall Street analysts rarely do this. They sit in offices crunching numbers. But you've got boots on the ground. Use them. Let's talk about the biggest mistakes that sink amateur investors. Mistake number 1, falling for hot tips. Your dentist, your barber, that guy at the gym, everyone's got a stock tip. Ignore them. Do your own homework. Mistake number 2, buying what you don't understand. Biotech sounds cool, but if you can't explain how they make money, don't touch it. Mistake number 3, over-diversifying. Owning 50 stocks means you can't possibly follow all their stories. Stick to 8 to 12, inside out. Mistake number 4, selling winners, keeping losers. People hate admitting mistakes, so they hold losers hoping for a rebound. Meanwhile, they sell winners after a small gain. Flip that script. Cut losers fast, ride winners hard. Mistake number 5, market timing. Trying to predict the next crash or rally is a fool's game. Stay invested, stay focused on companies, not indices. Let's talk about the magic of compounding. The 8th wonder of the world, as someone once said. If you invest $10,000 and earn 10% a year for 30 years, you end up with over $174,000. At 15%, over $660,000. At 20%, over $2.3 million. That's not luck, that's patience and good stock selection compounding year after year. But here's the catch. You need time. That's why I always say investing is a marathon, not a sprint. The longer you hold quality companies, the more the math works in your favor. Wall Street wants you trading constantly. That's how they make commissions. But you make money by sitting still and letting great companies do their thing. Start by looking at your daily life. What products do you use? What stores do you shop at? What brands do your kids beg for? Make a list. Then research each one. Who owns the brand? Is it a public company? Are they growing? Opening new locations? Launching new products? What do the financials look like? Is the stock reasonably priced? From there, narrow it down to 15 to 20 companies you want to track, follow their earnings reports, read their annual letters, watch for changes in the story, good or bad. When you find one that's undervalued with a strong story, that's when you pounce. You can't overlook the people running the show. Great companies have great leaders, people with vision, integrity, and skin in the game. Check if management owns shares. If the CEO is buying stock with their own money, that's a vote of confidence. If they're dumping shares, red flag. Also, read their letters to shareholders. Are they honest about challenges? Do they have a clear plan? Or are they full of buzzwords and excuses? Good management can turn a mediocre business into a winner. Bad management can sink a great business. Let's be real. Stocks are volatile. They go up, they go down, sometimes for no reason at all. If you can't handle seeing your portfolio drop 20% without panicking, you're not ready. Here's how to cope. Focus on the story, not the price. If the company is still growing and the fundamentals are strong, ignore the noise. Don't check your portfolio every day. Seriously. Once a quarter is plenty. Have a cash cushion. Never invest money you'll need in the next 3 to 5 years. That way you won't be forced to sell during downturns. Remember history. Markets have crashed dozens of times. They've also recovered every single time. Volatility is the price of admission. If you can't stomach it, stick to bonds or index funds. Knowing when to sell is tougher than knowing when to buy. Here are the signs. It's time to bail. The story changed. Management left, a new competitor emerged, debt ballooned, growth stalled. You were wrong. You thought it was a fast grower, but it's actually a slow grower. Cut your losses. It's fully valued. The stock's way ahead of earnings. The peg is above 2, and there's no room left for growth. You found something better. If you got a new opportunity with a better story and better value, make the swap, but don't sell just because the stock went down, and definitely don't sell just because it went up. Sell because the reasons you bought no longer apply. Dividends don't get enough love, but they're a huge part of long-term returns. A company paying and increasing dividends is a sign of financial health and confidence. Plus, dividends compound. Reinvest them, and you're buying more shares without lifting a finger. Over decades, that adds up big time. Look for companies with a history of steady or growing dividends. Bonus points if they've increased dividends for 10+ years straight. While I said don't over-diversify with 50 stocks, you also shouldn't concentrate too much in one sector. If you own 6 tech stocks and tech crashes, you're toast. Spread across sectors. Consumer goods, healthcare, financials, industrials, tech, energy. That way, when one sector struggles, another might thrive. But again, only invest in sectors you understand. If you don't know how banks make money, stay out of financials. People think you need $100,000 to start investing. Nonsense. Start with whatever you have. $500, $1,000, $5,000. The important thing is to start. Buy 1 or 2 great companies. Learn the process. Build confidence. As you save more, add to your winners or find new opportunities. The best time to start was yesterday. The second best time is today. You're going to make mistakes. I did. Everyone does. The key is learning from them. Keep a journal. Write down why you bought each stock, what you expected, and what actually happened. When you sell, whether for a gain or loss, analyze what went right or wrong. Over time, you'll spot patterns in your decision-making. Maybe you're too impatient. Maybe you ignore red flags. Maybe you sell winners too early. Awareness is the first step to improvement. Here's the biggest difference between amateurs and pros. Time horizon. Wall Street thinks in quarters. You should think in decades. When you buy a stock, imagine the market closing for 5 years. Would you still be comfortable holding? If not, don't buy. This mindset frees you from the daily noise, the panic, the fear of missing out. You're not trading. You're investing in businesses you believe will be bigger, stronger, and more profitable years from now. That's how you win. One of the best things you can do? Teach your kids about investing. Not in a boring way. Make it fun. Take them shopping and point out busy stores. Show them products they love and explain how companies make money. Let them pick a stock and track it together. The earlier they learn, the better off they'll be. And who knows? Maybe they'll find the next 10-bagger before you do. In 1990, I stepped away from Magellan at age 46. People thought I was crazy. Why leave when you're on top? Simple. I wanted to spend time with my family. I wanted balance. Money's great, but it's not everything. That's a lesson worth remembering. Investing isn't just about getting rich. It's about building a life you want to live. Don't sacrifice everything for returns. Invest smart, live well, and enjoy the journey. Let's bring it all together. Invest in what you know and can understand. Focus on the story. Why will earnings grow? Do your homework. Financials, management, competition. Buy undervalued companies with strong fundamentals. Hold for the long term. Let compounding work its magic. Ignore market timing and daily noise. Sell only when the story changes, not because of price moves. Learn from mistakes and keep improving. That's it. Simple, not easy. But if you follow these principles, you'll beat most Wall Street pros, not by copying them, but by thinking independently. The ultimate edge you have over Wall Street, you're not beholden to anyone. No benchmarks, no redemptions, no quarterly reviews, no groupthink. You can take your time. You can invest in small, overlooked companies. You can hold through downturns without anyone screaming in your ear. That freedom is your greatest asset. Don't waste it by trying to be like Wall Street. Be yourself. Trust your instincts. Do your homework. And invest with conviction. Beating Wall Street isn't about being smarter or having better tools. It's about being disciplined, patient, and independent. The stocks that'll make you rich are out there in your grocery store, your kid's school, your local mall. You just need to pay attention, do the work, and have the courage to act when others are asleep. Don't let Wall Street intimidate you. You've got everything you need: common sense, curiosity, and time. So get out there, start watching, start learning, start investing, and remember, you can't beat Wall Street by copying it. You beat Wall Street by being you. Now go find your 10 baggers.